It was a tough day in the stock market with the S&P 500 down basically 1%. But the action was actually a lot worse than probably the final outcome. Today we had entire sectors that were down with every single company within them losing money, and that included both the utilities and the real estate sectors. And the reason for that is their interest rate sensitivity. Today not only was a noteworthy day because it's the anniversary of Black Monday back in 1987 when the stock market crashed over 20%, but today was the first day where the 10-year U.S. Treasury yield hit 5% since 2007. So when interest rates continue to surge, as we saw today, then of course utilities and REITs are really going to struggle, and they certainly did. So we'll talk about those relationships in tonight's video. We'll talk about some of the areas that are holding up better than others, including energy stocks and commodities in general. Then we'll get into our trade application example, where I wanted to feature a sold put idea on a debt-free dividend aristocrat company. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 19th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also be given a heads up as to which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. Also, a quick side comment, I think David mentioned this to you here previously, but be aware that he is on vacation right now, and he'll get back at some point mid next week, but you will not hear from him in the next couple of days. So just wanted to make sure everybody was squared away with that information as well. In addition to that, we are heavy users of X, formerly known as Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ. We really appreciate those of you that click like and repost on these Market Outlook related content. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. So before we get started here, most of our premium members know this already, but I've been battling a cold this week, so I'll see how I can do here tonight. A couple of nights ago, I only got 2.5 hours of sleep, and it wasn't much better the night after that. Fortunately, last night I actually did get a full night of sleep, so I'm hoping I have the energy to get through this video without too much difficulty, but I will apologize in advance if it ends up being a little shorter than normal, and or I'm saying things that don't necessarily make sense, not because I want to do that, of course, but just kind of feels like I've got that disconnected head feeling that you get when you have a cold and you're taking all that cold medicine and everything. So anyway, I will apologize in advance if that affects tonight's presentation. Nonetheless, I'm at least putting the effort in for you here this evening. So with that out of the way, let's see what happened within the stock market today. And I can't say that it was a particularly pleasant day in the stock market. In fact, if there is a story of the day, first of all, of course, today represents the anniversary of the 1987 Black Monday crash, where we did have a 22% drop in the S&P 500 in a single session. Of course, we can't have that anymore because we have circuit breakers and other things in place to prevent that sort of thing. Nonetheless, it is a momentous day that is kind of listed there on your calendar and will forever live in infamy. In addition to that, if we fast forward to where we're at here on October 19th of 2023, it's also an important day from kind of a historical perspective because the 10-year U.S. Treasury yield hit a 5% interest rate here today. At least that's what I saw on CNBC. I looked at TNX on the Thinkorswim charts, and we'll look at that, of course, a little bit later. And it got to like 4.998. So I don't know if CNBC was just rounding up when they said 5%, or whether they have slightly different data than the Thinkorswim platform, not sure. But for all intents and purposes, it is a 5% interest rate on the 10-year U.S. government Treasury yield. And a momentous round number like that has not been seen since 2007. So many of you probably weren't even investing in 2007. Of course, many of you were, but you have to remember there's an entire generation that started investing not just after 08-09's great financial crisis, but another generation really started investing after 2020. Remember, we were talking about those statistics where it was like 15% of market participants started investing for the first time after the COVID wipeout in March of 2020, many of them using their COVID stimulus checks for the first time to buy stocks with that. And I'm sure they are probably looking at today's market activity and wondering if they made the right decision by investing their money as things have gotten a little bit chaotic to the downside. But I always like to remind folks, David and I have been at this a long time. Both of us have been investing for more than 20 years. And in my case, I started investing pretty much right at the top of the dot-com implosion or dot-com bubble back in the year 2000. And of course, I took my licks back then, just like many people are taking their licks right now. And I would not have changed it. Now, of course, you can always look back and say, well, I wish I would have done this or that or the other thing. But in terms of, was I disappointed that I became an investor in one of the worst times in history to become an investor? Looking back, after these 23, 24 years later, my answer is always the same. It was a blessing that moment you take that first step to invest, because over the long haul, the stock market does make money. And even though we have to kind of put up with the negativity from time to time, as we are right now, in the end, it is going to almost always be considered one of the best performing asset classes out there. So is it difficult? Is it strenuous? Does it tax you? Is it emotionally draining? You could probably answer yes to all of that. But is it worth it in the end, years later? You could also probably answer yes to that. If you just look at, the wealthiest individuals on planet Earth and ask, the basic question, are they investors in either private businesses or publicly traded companies? I would say the vast majority of the wealthiest people out there do have their money working for them in businesses. And so don't want to spend a lot of time on that in this type of a video, but I know there's probably been some of you who are seriously second guessing your decision to become an investor. And I'm here to tell you, as a survivor over the years, that there will be better days in front of us, and we just have to learn to get through these difficult periods, and therefore we can see the rainbow on the other side of the storm, so to speak. So anyway, today, another difficult day because of there's surging interest rates. And you can see the havoc that it wreaked upon most of the stock market. You have a handful of green patches out there. The most notable one is probably Netflix, up 16% here today. That was an incredible move. I think I heard them say that it was the best one-day performance for Netflix in a couple of years, and that makes sense. 16% is nothing to sneeze at there. That's a big number. And so that's a $178 billion company. Of course, used to be part of the whole FANG trade that was eventually kind of displaced by the Magnificent Seven. So in a way, Netflix kind of got left out of that party, but maybe they shouldn't have. They are still a very disruptive force in media, and today just proves that out once again. So congrats to all of you Netflix shareholders out there. One heck of a day. AT&T also had a strong day, up 6.5%. Verizon was up 1.7%. So, those areas are some of the more important communications stocks out there, but they are not the most important ones. Alphabet and Meta are more important than them, and both Alphabet and Meta were down just a little bit. Alphabet actually held up pretty well. They basically were flat, just a touch lower. Meta was down a bit more, down 1.31%. So kind of an interesting day there within the communication services space, but a couple of big winners there nonetheless. In terms of some of the other Magnificent Seven companies, you'll notice that Microsoft actually closed higher today by 0.37%. Apple was down just a touch, so those two probably just effectively offset one another. We had NVIDIA down just a touch, down 0.23%. And then, in the other area over here towards consumer discretionary, we had Amazon up 0.21%. So you can see that for 6 out of the 7 Magnificent Seven, we had a pretty mundane day. I mean, those are movements that you would see, if the market was exactly flat type of a thing. But then the seventh of the Magnificent Seven, that was a real doozy, and that is the bright red patch you see in the upper right-hand corner here, and that is Tesla. And it was down significantly today, down 9%. Remember, this is a $700 billion company that just saw 9% of its value disappear. And one interesting thing about Tesla is it was one of the worst performers in the S&P 500 today, but as I looked after hours, there were a couple of solar plays, and some of you saw me tweeting about this earlier this afternoon, but in the after hours session, Enphase and Solar Edge are down like 20% after hours. So tomorrow we're going to get a couple of other stocks that are going to be not necessarily as damaging as Tesla, because Tesla, of course, has such a massive market cap. But in terms of, eye-popping numbers on a percentage basis, there's going to be some big movers tomorrow as well. And remember, tomorrow is an important day because it's options expiration day for the month of October. So make sure you're babysitting your positions there if you need to. So that's your Magnificent Seven. Beyond the Magnificent Seven, you can see it was mostly red out there. You didn't really have a whole lot of consistent patterns in terms of anybody willing to buy stocks here today. You had maybe a little bit in the restaurant space with McDonald's and Starbucks and Chipotle and Darden all up a little bit. Las Vegas Sands was a little bit of a one-off story because they reported their earnings, but that stock was up nicely as well. So maybe a little bit in kind of the travel and restaurant area, but that's not enough to really have a positive impact on the market. You did see Union Pacific up nicely today. I think they reported their earnings, and so that stock was up 2% here today. Lockheed Martin was up. Of course, that stock's been in the news a bit more lately with the outbreak of war in Israel. We had Coca-Cola that was up 0.5%. Not a huge deal there, of course, but maybe viewed as a little bit of a safe haven here more recently. As I mentioned in one of my recent videos a couple of weeks ago, Coca-Cola actually dropped into the blue zone of the dividend stair-step chart for the first time in, I want to say, 3 years. That's how badly those consumer staples companies have been trading. But you had to be very quick to catch it there because it only lasted for 1 day. And sometimes that can happen, and it's bounced out of there pretty nicely. The same thing actually happened to Pepsi as well. So both of those touched that blue zone and then popped out of it 1 day later. Speaking of that blue zone, I did just post this to Twitter here a moment ago as well, and might as well bring it up since it's on topic. And here, by the way, is that graphic that I was mentioning before where it shows that the 10-year Treasury yield hits 5% for the first time since July of 2007. But it's this post right here that I wanted to reference, where I said, as of today's close, 52% of the nearly 700 dividend growth investing stocks that I calculate historical dividend yields on are in the attractive, undervalued blue zone of the Market Scholars dividend stair-step charts. This is the highest number I've recorded. So anyway, not to say that that is meant to mark a bottom or anything like that, but as I go on to say later, to put that into perspective, where over half, just barely over half of the investable universe is at a point where their dividend yields are considered to be attractive right now versus their historical standards. I say to put that into perspective, in fairly typical markets where interest rates aren't surging every single day, only about a fourth of stocks would meet that criteria. So that is a massive difference, 25% versus 52%, right? Just inverse those two numbers, 5.2, 2.5. But your traditional bell curve is you got about 25% of stocks that are trading in their blue attractive zone. You have about 50% of stocks in the white neutral zone, and then 25% in the orange overvalued zone. So you have kind of your traditional distribution of a bell curve where you've got your tail ends at 25 and the middle at 50. Well, right now you're basically in a territory where you could throw a dart at 700 companies And odds are higher that it would land on a stock that is at a historically high yield right now than not. And that is really saying something. And of course, there's always the possibility that we've entered into a new era here where interest rates will remain higher than what most of us have been used to in our careers thus far. And therefore, it's possible that for years in the future, we will see higher interest rates and dividend yields on stocks, and those will need to adjust higher as time goes on. Remember, in those calculations that I do every year, it gets adjusted as time goes on with the new yields that are added into there. So those are not static numbers. So there's always that possibility. But if we are near kind of a topping out of interest rates at around these levels, and we find ourselves at much lower interest rates, let's say a year or two from right now, then I have no doubt that there are some very interesting choices out there amongst high quality dividend growth stocks right here, right now. As I say, while stocks can always go lower and no one knows where the bottom is, the odds of success for new money going into high quality dividend growth companies are becoming more favorable by the day. So, we'll see where that takes us, but I wanted to share that little tidbit with you because it was unique. Again, that's the highest number I've ever recorded right there. Basically, throw a dart. There's a good chance it's going to land on a company that is trading at an attractive zone based upon average high yield theory. Where were we? Back to the original conversation now. Over here on the heat map. So Coca-Cola was up today, and one of the safe havens there. Monster Energy was up a little bit today as well. Not a big deal, but just pointing it out because there weren't a whole lot of green ones out there to talk about. We had Exxon and Chevron both close higher by the slimmest of margins, but you could probably get away with calling them flat. So I wouldn't say that was, a major move or anything like that. A couple other the tech stocks over here. You had Salesforce and ServiceNow have decent moves there, but they're just not big enough companies to make an impact on the overall market. Other than that, not a whole lot to get excited about in the market. You can see lots and lots of red out there. Eli Lilly took a tumble today. Of course, that's been one of the rocket ships of this year with their weight loss drug. It was down 2.7% today. We had AbbVie take a hit today, down 2.5%. Palo Alto Networks was down 3%. Some of the semiconductor-related names, Applied Materials, Lam Research, down about 5 to 6% in that general vicinity. You had a fairly big financial company. This is Blackstone, not BlackRock, but Blackstone is still an important company from a private equity perspective. They were down about 8% today. Discover was down about 8% today. I had to do a double take when I saw that because some of you that are part of our premium members here at Market Scholars know that I do a question and answer session each week, and I happened to do mine last night without any knowledge of what would happen in the stock market today. And the person had asked me about 3 different stocks and kind of wanted me to have a conversation about how I would rank them. And they had ranked Discover a bit higher than I would have of those 3 companies. And I said Discover would actually be my least favorite of the 3 that we were looking at. And of course, I didn't know that it would fall 8% today, but it was just kind of interesting timing to say the least. So that credit card company really took a tumble here today. Rollins, which is kind of like a pest, termination type of a company, I guess you would say. Housing services related play was down 8% today. You had a lot of the auto parts companies struggling. O'Reilly, AutoZone were down. We actually looked at AutoZone in our swing trading class earlier this week. Thankfully, the class did not vote for that one because that would have been almost an immediate mistake there as this stock was down pretty significantly. But it was actually looking pretty strong earlier this week, so interesting to see that reversal there as well. Albemarle was down again. It was down tremendously yesterday and followed that up with another fall flat on your face, 5% loss there. And then the real estate stocks really catch my eye as well. As I noted on Twitter last night, something happened here with Crown Castle that was worth noting. And this is the type of stuff that I try to share with you guys on Twitter, whoever follows me there, because I know Twitter is kind of perceived as a place where you go for active trading information. And I want to kind of dispel that myth to a degree as a long-term investor and provide, important information for long-term investors there as well. And like I mentioned here last night, let me see if I can find the post. Yeah, right here. Said FYI, it looks like CCI just announced a $1.56.5 dividend. This will be its fifth straight dividend at that rate. Typically in the past, it would have raised it after its fourth at that prior dividend rate. I've been seeing a lot more of this sort of thing lately, which is true. There's a number of companies, and I'm like, that's not necessarily the best of sign, right? They're kind of sending a little bit of a message where normally there would have been a dividend increase after the fourth at the prior rate. That's just how typical corporate America works. And so when they don't do that, even if they don't cut it, like this one did not, it didn't cut its dividend, it just kept it the same as where it was for the previous year. It's kind of sending the message, if you're reading between the lines, that not all is well with that particular company. Of course, I was mentioning that with Whirlpool here earlier in the week as well. So there's been a handful of companies that have done that lately, and you can see that the stock market, once it was able to react to that news today, because remember that news came out yesterday after hours, but today CCI was down about 5.5%. Not a great look there, and you really didn't see much of any benefit whatsoever in any of those utilities or real estate area. From what I can tell, it looks like all of them were down. Let me just see if I can zoom in on the utilities to confirm that. And yes, as far as I can tell, every single one of the utilities in the S&P 500 was down today. And then if I go into the real estate and do the same thing, every single one of the the real estate stocks were also in the red. So, that's a pretty one-sided market where two entire sectors had nothing but selling. Not a single company. I'm sure there were companies in both the utilities and the REITs that probably had a press release today of some sort of positive news that happened with their business. It didn't matter. What mattered today was the stock market waking up to the fact that we now have 5% interest rates and how much interest rate sensitivity those two groups have had, as we've been talking about for years in this presentation, and most of you are well aware of, but now we're all seeing just how much of a disaster that can be when you have that interest rate sensitivity. So anyway, some really ugly performers there in those two key interest rate sensitive areas for sure. Let's go ahead and pop on over here now to the main part of the platform and take a look at our breadth numbers. I've got the S&P 500 pulled up here. And as you can see, I've got about 76 companies in the S&P 500 closing in the green today. That's only 15%, which tells me that 85% of companies closed in the red. That is a pretty one-sided day, right? And we've actually had quite a few of those more recently where we've had 80% plus in either the green or the red on a day. So, we've had one-sided markets, and unfortunately, more of them have kind of shaken out to the bears lately than to the bulls, right? You'd like to see those type of statistics, piling up on the up days of the market more aggressively, but we just haven't seen those stacking up at the same rate that we've seen them stacking up for the bears. So not a good day in the market whatsoever, and it was probably worse than it actually looked. The market itself, if we go over to our charts now, was actually down. The S&P 500 was down just 0.85%. That doesn't even sound like a lot, right? Excuse me. Sorry about that. I'm not as good about hitting the mute button as David is, so I should probably learn that. Then again, I'm not usually doing this presentation when I'm sick, so my apologies for, you just never know. You start talking and something starts hacking up some phlegm out of your throat. So my apologies there. Anyway, I was saying that the S&P 500 was only down 0.85% today. That's not really even that big of a deal, right? It was down 1% at the exact lows. We got a little bit of a bounce at the end of the day. So we did have a 1% down day earlier in the session and just closed barely off of that. But remember, that does follow up yesterday where we did have another 1% down day. So you're basically looking at two straight 1% down days when you combine them together. So that'll do some pretty significant damage to the market and really to the psychology of the participants of the market, especially when they're lined up where this is all happening, right? Because as you guys are aware, when we're trying to read the charts and try to, guesstimate where we think things are trending, that this was not the best of looks for the market. You can see clearly that we have had a series of lower highs and lower lows. Right here, of course, was the high for the S&P 500 on July 27th. We then had a lower high here on September 1st. We then had another lower high here on September 14th. And now we've had yet another lower high here on October 17th. And you'll notice that during that entire move, very few times have we closed above the 30-day moving average. You can also see very clearly that you had a low here on August 18th, and you had a significant lower low here on October 3rd. So from my eyes perspective, we have not yet broken out of that downtrend that we are in the midst of right now. And that's talking about one of the better indices out there, right? In other words, it could be a heck of a lot worse. We should all send our thank you cards to, the headquarters of Microsoft and, Alphabet and a handful of those companies that are basically propping the market up right now, because this could have been a lot worse today. If you look at the average, activity within the market, to me, it felt a lot worse than 0.85% to the downside. So I don't know if that's a good thing or a bad thing, but just pointing it out because, yeah, it's not the best of feelings out there. And I think it's one of those precarious positions as well where, there's been a lot of strain within the market, and it does make you wonder, if one thing is going to lead to another and stuff starts breaking behind the scenes, right? Usually we have those conversations after it's already broken, but after you've been in this business long enough, you start to get the sense of what types of market dynamics could lead to things breaking within the market. And without a doubt, surging interest rates could very well be one of those things, because a lot of people just simply were not prepared for this type of a deal, right? Most of us as investors have been investing in a market where interest rates have been falling for decades. And so you even have professionals that were not well equipped for this moment where interest rates did the exact opposite of what they've been doing for decades. And I have no doubt that there are some people, using leverage and other instruments out there that are probably, saying some Hail Marys here today, because this is the type of thing where when you're highly leveraged and you're on the wrong side of the trade, you might have to start liquidating the rest of your portfolio. If you're a big hedge fund manager that's getting their wings clipped right now, and when that starts happening, it's like a fire sale out there. I mean, all bets are off. It's kind of like sell at any price, and then you get cascading stock prices, and that leads to other people who are also leveraged in those other stocks that are being sold just as kind of secondary thoughts to the main hedge fund also having to liquidate theirs, and it starts this domino effect type of a thing, right? So I'm not here saying that is just around the corner or anything like that. I'm just saying this is the type of market environment where that type of behavior is going to be more likely than not, right? And so don't be surprised at all if this type of thing continues and we start seeing interest rates surge beyond 5%, if we start hearing news stories of hedge funds that are blowing up. And, it's possible that Jerome Powell and others would have to step in and try to salvage things. But they're in a pickle as well, right? Because they've got their own job to do, which is to make sure inflation isn't running out of control. And right now, the economy itself is still somewhat solid, and employment is solid and all that kind of stuff. So I'm sure that Jerome does not want to lower interest rates. The stock market might be screaming at him to do so, but he's saying, I got a different job that, as much as I feel bad for you guys or for the bond market or what have you, I don't work for you guys. I work on behalf of the U.S. government, and I need to make sure that I'm doing my best to keep inflation under control and also have a reasonably strong employment market. And so, it has the possibility of really shaking out the wrong way for investors. And so we just have to brace ourselves for that. And again, do your best to make sure that whatever companies you own, you want to own them, right? Because you might find yourself in a position in the future looking at things in your portfolio, wondering to yourself, well, why in the world do I even own this, right? This company doesn't even make money. It doesn't make profits. It was a speculation type of a thing. And you got to be careful with putting too much of your portfolio in those. You can have a few, wild cards and firecrackers and lottery tickets in there from time to time, but those tend to work out a lot better when market conditions are bullish. I wouldn't really classify what we're looking at right now as bullish market conditions, so they can also blow up on you very, very quickly. So you got to be very careful with that sort of thing. Anyway, S&P 500, we do have a strongly bearish posture again after trying to get that reversion to the mean move up to that falling 30-day moving average, and then now rolling back down away from it without getting any sort of a true push above it. And that was my fear last week, right? Remember when I was telling you guys that, hey, our posture moved back to weekly bullish, but I wouldn't trust it any more than I could throw it, simply because we had not proven that the market wanted to get above the moving average yet. And this is the reason I made those comments last week for exactly what we've seen in the last 2 days. You've got to be careful with looking at just one indicator. It's the accumulation of multiple things that you're looking at that should lead to what you think will take place in the market. And so in my own eye, looking at this downtrend that still had not been broken to the opposite direction as an uptrend, my spidey sense was telling me that this was not a time to to have a celebration or to throw a parade. We needed to actually get substantial time above that moving average, and instead the exact opposite happened. You had a couple of days where you tried to get above the moving average and it failed immediately. And now here we are again wondering, okay, is this the next leg lower? Are we going to be pushing through 42.16 within the next week or so, right? So we'll see, but I don't think the market looks particularly good right now. Fortunately, we do have November and December right around the corner, and January, and that is the best 3-month period in the stock market from a seasonality perspective. And it is true, money does start to come into the markets at the end of the year, Santa Claus rally and all that kind of stuff. So maybe, just maybe, we'll get bailed out by a seasonality perspective. But right now, you're kind of fighting against the path of least resistance. And at this exact moment, the path of least resistance, to my eye, remains to the downside. So anyway, strongly bearish posture below a falling moving average for the S&P 500. The Dow held up the best today. It was down 0.75%, so it was still down, and it still looks ugly on the chart, right? Just because it was the best performer today doesn't necessarily have to mean that that's going to be where you want to place your bets, because stocks generally travel in the same direction. And to me, it looks like the Dow is doing the same thing as the S&P 500. In other words, bouncing down and away from a falling 30-day moving average. Prices below that moving average, we have that strongly bearish posture there as well. NASDAQ Composite was down 0.96% today. And so it was worse than the S&P 500. That was probably courtesy of Tesla. When you have a day when Tesla's down 9%, that's going to have a big impact and is going to offset the slightly positive move out of something like Microsoft, as an example. So same conversation here. The NASDAQ had a slightly better attempt to the upside, but still, you look at this and you say, was this downtrend ever broken? No. You had a couple more days where it tried to stay above that moving average, so it at least made a better attempt at it than the S&P 500 and the Dow, but still, you needed more time above there to prove it, and it just simply is not proving it. In fact, it's being used as an area of selling for a lot of people that are trying to lighten up their portfolios right now. Can only imagine what Warren Buffett is thinking behind the scenes right now. Of course, most of you know his cash pile has never been higher, and a couple of years ago, people were giving him the business about that, and I'm still waiting for those people to offer up their apologies for calling him a bonehead or whatever they called him a couple of years ago, when he was just gorging on cash and was not using that cash to buy securities. Well, fast forward to where we're at today, I can see who is having the last laugh. And I have no doubt that if we do have a true wipeout in the stock market on the horizon, Buffett will then be willing to use that cash that he has been so patiently hoarding here in the last several years. Anyway, You can see here that the NASDAQ has rolled over now as well, also has that strongly bearish posture and is below its falling 30-day moving average. And then last but not least is the Russell 2000. I guess I could say it is least because it was the worst today. It was down 1.51%, and it has been the worst, right? We've talked about that as well. Last week I was talking about how the intermediate line was the lowest of the other three indices out there in a way to identify that this was our true laggard. And that remains the case today. It was our laggard on a one-day basis. It's our laggard on a year-to-date basis. In fact, it's the only one of these four right now that has a negative performance on a year-to-date basis. Just barely the Dow is up. But it is our worst performer on a 3-month basis. It is our worst performer on a 6-month basis. And on a 1-year look back, it is also the worst performer and also the only one that is down over that time period as well. So as you can see, all of those time period labels on the Russell 2000 are red with negative performance over multiple time periods. It's the only index that can make that claim. So it is our true laggard at this moment. You will see that once again, it did have an oversold cluster signal using the daily candle chart. So, you'd like to think there will be some sort of a reversion to the mean, and we thought maybe this could be something right here where we had 5 days in a row. But since we didn't break that 30-day moving average, it's hard to trust that. And then we rolled over again, got another oversold cluster, went up for 2 days in a row after that, rolled over again, and now all of a sudden, look at the low tag. This is the only chart that has the low tag under today's candle, and we do have yet another oversold cluster signal. So, could we see it up tomorrow and early next week? Sure. But until we start spending more time above that moving average, you have to be very cautious in, your expectations of this chart. Anyway, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you who help support these presentations. And as I always say, as long as we're up and over 100 likes, I'm happy to give you a full-length video the next time around, even as is the case today, if I am sick. As long as I've got the energy to do it, I will try to put in that effort for you. So even if you're not somebody who is one of my regular likers, if you appreciate the fact that I just didn't decide to skip the video today because I was under the weather, maybe today I will earn your like. Maybe I won't. Some of you have refused to click like no matter what, and you have your reasons for that. No problem there whatsoever either. Thankfully, the others are picking up your slack because 106 of you clicked like for me last time around, which I certainly appreciate. Of those 106, let's go ahead and do some shout outs. Thank you to Phil, thank you to Arthur, thank you to Andre, and to Roger, and to John, and Deborah, and Ken, and Dave, and Serene, and Michael, Jayesh, and Catherine, and Tom, and HR, Floyd, Ron, Vernon, Eugene, Terry, Paul, Dan, Brad, Vince, Brent, Kenneth, Sonia, Adam, H. Battelle, Brandon, Richard, T-Fib, Ann, Doug, Irene, Austin. The list goes on and on and on. I can't get to all of you. It would soak up too much time, but my hope is that every so often, those of you that are loyal to David and I and take the 5 seconds out of your day to share your appreciation by clicking a button for us, that you hear your name rattled off every so often. So thank you again. And, if you want me to do another full-length video, the next time I'm scheduled to do the video on Tuesday, then click like, and if we're up and over 100, I'll be happy to do that. Otherwise, if you prefer the shorter ones, obviously those are a lot easier for me to do, and I don't have to put in as much effort and energy on them. So if that's what you want, it's easier for me as well. Don't click like, and more than happy to go that direction as well. So in the end, it's up to you and what you guys want collectively. Do you want more content or less content? And if you want more content, then asking somebody to click a free button for 5 seconds is not too much of us to ask. At least we don't think so. All right, let's go ahead and take a look at our sector selector now from our website. A reminder that this does get put together over the weekend. So since This is the first time I'm doing the video here this week. This is the first time we've had a chance to look at this information. Of course, we did look at this in my premium class on Monday already. So for those of you that are members of Market Scholars, you're already aware of this. But for those of you that are just watching the free YouTube video, you do have a bit of a delay when you're looking at this information. That's one of our perks, of course, of joining our our premium service, I should say. And remember, next week is our next month, almost next week, but not next month is November. And it's typically in November when we start doing our Black Friday sale, where you can save 20% off of our 3-year premium membership. So if that's something that is of interest to you, I would encourage you to take advantage of that discount. And of course, we will mention that as we approach that sale here in a few weeks. So stay tuned to that as well. Anyway, taking a look here at the sector selector, you can see that energy remained number one. This is the 11th straight week out of the last 13 weeks, the 11 in a row with energy to the upside. So if it manages to stay up there for 2 more weeks, then you're going to have the rare clean sweep up there at the top, kind of like a Connect 4 type of a thing almost, right? And you don't see that very often, but it just goes to show you what kind of a market we're in right now, where inflation is a concern. Geopolitical news in the Middle East is a concern. Those are the types of things where energy can be a superior investment compared to other stuff that is out there. And so it's kind of allowing it to weather the storm a little bit better than most of these other areas. Information technology managed to get up to the number 2 position, where it was back here at the beginning of September. Remember, 3 months ago, we actually had technology as number 1. And while it's been a while since they've been number 1, at the same rate, I've also been quite impressed with them because we've had a lot of selling in the stock market. And oftentimes, your tech stocks are your higher beta stocks. And a lot of times when markets go down, they get punished even more. This has not been the case this time around. If anything, tech is what is holding the market up better than it deserves to. And so the fact that you have stayed kind of in that top 4 the entirety of the 3 months is impressive. It's the only one of these sectors that can make that claim, because exactly 3 months ago, energy was actually down here at the number 5 position, and then it went up to number 2 the next week. But with technology, you can see the lowest position it's had along the way was right there, number 4 position on September 15th, and it has been above that every single other week. So technology has been a stalwart, and we can thank Microsoft and Apple and those types of companies for that. Industrials made another advance. That was their second straight week of improvement in their rankings. Remember, industrials is where you're going to find your stocks that are in the aerospace and defense industry. And so your Lockheed Martins and General Dynamics and Northrop Grumman's and Raytheon's, those types of companies that have got a little bit of a shot in the arm here as a result of some of the outbreak of war, that might be helping those to a degree. Financials took a bit of a tumble. Financials have been interesting lately as well. Of course, we've started earnings season now. Remember, the banks are usually the first big group to come out of the gate with earnings season. And the market doesn't seem to be treating the banks nearly as well as it did the last time around. Remember back in July when we had the banks come out, a lot of them went up pretty nicely. It was somewhat short-lived because a month or two later they gave up those gains, but nonetheless the reaction initially to earnings from the banks back in July was really impressive. And I think part of the reason behind that was that in March we were dealing with the regional bank crisis, and I think there was a lot of negative sentiment on the banks that particular earnings season. And when they came out with reasonable earnings, it was kind of like a collective sigh of relief. This time around, we weren't just removed from the regional bank crisis, and I don't think that same dynamic was in play. And so now markets are kind of taking it for what it's worth, and right now there's a little bit of stress there in the system. So those are our top 4. They were actually the same top 4 as last week. We just had kind of a reversal of some of the rankings. Sorry, my throat is getting so dry right now. I may have to put in a cough drop. Hang on just a second. Tried to swig a couple of drinks of water, but that did not seem to help. It just kept on getting drier, so hang on just a sec. All right, I think we're good. How's that for production value? You can hear me, opening up my cough drop, and I'm just joking with you, of course, but I appreciate you guys bearing with me and staying patient as we're getting through this together here. But an important day, and one I certainly didn't want to miss, because I'm sure a lot of you are wondering about what's going on here today as well. By the way, notice down at the bottom of the sector selector, consumer staples stayed dead last once again. And, that's partially due to the interest rate sensitivity that we've been discussing for a long time now, but it's also partially due to the weight loss drugs and the impact that they've had in particular on food and beverage companies. It has been a house of pain in a lot of those areas here more recently. Somewhat more, surprising, at least to me, because, we've been dealing with consumer staples with their lousy position for quite some time. But it's a little bit more surprising that the discretionary stocks all of a sudden find themselves at second to last. That is the worst position for consumer discretionary in the last 3 months. Remember, 3 months ago, we were talking about consumer discretionary being one of the top sectors back in July. And so they've really reversed course here. And it may be signs that the consumer is feeling pinched and stressed, right? We all can see the prices of goods and services going up around us. And it's maybe making us second guess those purchase decisions, right? Kind of pulling in our horns a little bit compared to the freewheeling spending days just post-COVID when we had stimulus checks and different things like that. And so it makes you wonder if that's having a little bit of an impact on the profitability of the discretionary sector. And that's part of the reason why the average discretionary stock is now kind of struggling on a relative basis to the other sectors that are out there. Real estate and utilities also in the bottom four. No surprise there whatsoever. In fact, based upon what I've seen today, wouldn't be surprised at all that when I put this graphic together again this weekend, if real estate and utilities fall in the rankings again, and discretionary might go up, not necessarily because it's doing well, but just because real estate and utilities are just getting hammered here based on surging interest rates. So we'll see if that plays out or not, but that's one thing I've got in the back of my mind right now. All right, let's pop on over here. Do some 12 grid analysis on the Thinkorswim platform. By the way, I mentioned this earlier as well, but tomorrow is options expiration. I did go back and check a number of the trades that we've done in this presentation. Of course, I don't have access to David's account. We have separate accounts for these videos that we do, but of my trades that I've done over time, I had to jot down a bunch of them because one of my platforms transitioned from TD Ameritrade to Schwab, which complicated matters a bit. But anyway, there were 4 ticker symbols. Actually, there were 5, but one of them, Kellogg, we had already bought back our short put on before they did their spinoff of WK Kellogg. So that was a little confusing there as well, but that was something that we had talked about in our premium classes here. Another benefit to joining our services, of course, is that we do talk about these trades that we're discussing here in these free videos in a much more in-depth way, if necessary, in our premium classes. And I had mentioned to the class and also sent out the notifications and all of that on our private Telegram channel when I did it a few weeks back, whenever it was. But I did buy back the sold put on Kellogg because when I initially put that trade on, I didn't know that they were going to be spinning off Kellogg's cereal division, North American cereal division, within the time frame of our options trade. I knew they were spinning them off. I just assumed it would be later in the year. So anyway, I decided to buy back the Kellogg sold put to avoid that headache, and took a small gain on it, and probably got lucky on that as well, knowing how poorly Kellogg and consumer staples in general have been trading the last few weeks. So sometimes better to be lucky than good. But with some of the other trades that we had going that will expire tomorrow, one of them was AMD, and AMD was actually a bearish trade that I had done. It was the October 115-120 bear call spread. And with this stock trading at 102 right now, as long as it doesn't somehow surge up to 115, that should be a max gain for us tomorrow. So that one we're golden on. Shouldn't have too much stress on that one, I wouldn't think. Another one that expires tomorrow was our Halliburton trade. This was a bullish trade. This one was a bull call spread, right? And that's a debit spread. And with this type of a trade, it was the October 40-41 bull call spread, which What we want to have happen is for the stock to stay above $41. And with it trading at 43 right now, it looks like that is what we have in store. Now, obviously, it could drop $2 tomorrow. I don't know the future. But right now, I'm feeling like this is another one that is likely to go to max gain for us tomorrow. Another trade that expires for us tomorrow was Amazon. This one was a bullish trade, and when you look at this chart, it doesn't look particularly bullish, but fortunately, strike selection plays a pivotal role in what it is that you're doing as a trader. And in this case, we sold the October 125, 120 bull put spread. And so what that means is we want this stock to be above 125. And if it is, then we will have a max gain on this as well. This one's trading at 128 right now. So you would think, the odds are certainly on our side, but you also have to recognize Amazon is a pretty volatile stock. It is not entirely surprising when you see it move $3 in a day. So if it does happen to have a big sell-off tomorrow, keep your eye, if you're a premium member, on our private Telegram channel. And if I need to make a move, as always, I will notify you guys based upon what actions I'm taking. But for right now, we're looking good on that one as well. And then Vertex was another one that I had written down, VRTX. And on this one, it was another bullish trade. And it was the October 340, 330 bull put spread. And so what we want on this one is for it to stay above $340. And obviously that's pretty much a shoe-in with this one. I have no fear on this because $340 is way the heck down here. This stock is not going to fall $24 tomorrow. At least I should hope not. So, I think we're in pretty good shape on this month's inventory, which I'm thankful for. Some of our other trades in future months aren't going quite as well, but we'll take what we can get. You can't win them all, of course. You're trying to do the best you can with the information you have at any given moment in time. And in this case, where we had 3 out of our 4 trades that were bullish trades, not bearish, and we've been in a very bearish market environment, you should feel extra lucky when you're in that position of winning all of your trades, despite most of them being bullish when markets are selling off left and right. So knock on wood, hopefully we can find some other good trades in the future. But for right now, feeling pretty good about closing out October's inventory tomorrow at max gain on most of those trades. All right. And make sure you're babysitting your positions as well, right? Because you guys have your own trades going on, and some of them would be from other classes as well. For instance, I've got a options for long-term investors class where one of our stocks is in the money right now and could very well, be exercised tomorrow. So there are some other things I'm looking at in other classes, and you guys, of course, have your own things going on with outside trades and all that kind of stuff. So just a friendly reminder, with as volatile as markets have been lately, tomorrow's expiration day, and make sure you're babysitting your positions if you need to. All right, let's get back on over here now to our 12 grid analysis. And as you can see here, our first set of 12 grids is our asset class 12 grid, and we're going to get started in the lower right-hand corner because, as I mentioned before, this is pretty much the story of the day. TNX, that's what you pull up to check the 10-year Treasury yield on the Thinkorswim platform. And remember, you move that decimal place over 1. So in other words, in order to read this, you would see that the 10-year U.S. Treasury yield is at 4.98%. Basically 4.99% if you rounded up. And it did close just a little bit off the highs, so it basically touched 5% today for the first time since 2007. Quite a noteworthy achievement, not one that I enjoy, but an achievement nonetheless. And you can see that has just been a runaway freight train. How many times did I bring up that comment in the last 3 months of doing this video with you guys, that if you would just simply replace TNX with your favorite growth stock, how you would be just licking your chops at this opportunity. I mean, how impressive does that chart look? It looks amazing. It never broke that uptrending 30-day moving average, never even came close to it, really, in most of the entirety of that 3 months. So this has been a one-way trajectory type of a market, and it has wreaked havoc on other portions of the market, like utilities and REITs and what have you. But, This is kind of more of a normalized interest rate environment if you go back over several decades. So it's not meant to suggest that just because it went up a whole bunch that all of a sudden now it's got to go down a whole bunch. We could just be at elevated levels for the next several years for all I know. So we'll keep our eye on it, but right now the uptrend remains very much in place. Obviously there will be some sort of a pullback eventually, but the question is, will it break its 30-day moving average? And for each attempt at that in the last 3 months, the answer has been no. So I have no reason to believe that the next one will result in a no. But if it does, I'm sure that I'll let you know right here in these videos. So when interest rates are surging like this, of course, the opposite is happening to bond prices. And you'll notice that TLT was down 2% today. That's a huge move on the long-term U.S. Treasury bonds. We are now at a new low on TLT here, as you can see as well. It did have an oversold cluster signal, so perhaps an excuse to get a little bit of a reversion to the mean. But on a day where you're at multi-year highs on Treasury yields, of course, you're at multi-year lows on long-term U.S. Treasury bonds. So this has not been a pleasant year for those investing in the bond market either. You can see here foreign bonds also were down a little bit today. And then high yield bonds were also down a little bit today. High yield also has an oversold cluster signal. All three of those charts clearly below their falling 30-day moving averages and have strongly bearish postures. You can see that in the lower left-hand corner, the US dollar was down today, and it actually has a weekly bearish posture. But as I mentioned to you last week when we saw the same condition, be careful, throwing that chart out too quickly. In other words, it's still above its rising 30-day moving average. So until it starts breaking down that, below that more considerably, I'm going to assume that there's a good chance that a bounce could occur here with the US dollar, which is not what I want to see as an investor, yet I'm a realist, and it is what my eyes are seeing at the moment. But today was a day where the dollar was down a little bit. And so when the dollar is down, sometimes commodities can go up, and that is what we found today. Gold surging over 1% today, oil surging over 2% today. Both of those charts look pretty interesting here all of a sudden, right? Oil has looked interesting for much of this year. Pretty good setups there over and over again. Gold has not. It's really just been a 2-week surge in gold that has basically rallied us all the way back up to almost 3-month highs. Before that, gold looked quite poor. So it makes you wonder if gold is starting to be viewed as a bit of a safe haven here. All of a sudden, again, you can see gold now has a uptrending 30-day moving average, just like oil does. So both of those looking much better here than like the stock market. You can see that up here, the foreign stocks didn't close higher today, but developed stocks basically matched the U.S. performance, and emerging stocks actually did beat the U.S. performance, even though they were still down. And, that may be partially due to the fact that the dollar was down today. But all three of those key areas up there at the top, U.S. and then the two international versions, all have strongly bearish postures and are falling down below their falling 30-day moving averages. Preferred stocks got hit hard today. Remember, they act like bonds more times than not. They were down over 1%, which is a huge move for preferred stocks. That's a new multi-month low. They also have an oversold cluster signal here. Bitcoin actually managed to close higher today, so that could be perceived as a nice alternative asset class in times of chaos. And while you might not respect it as much as you might respect something like gold, it is different than the stock market. And if you're looking for something that's not necessarily correlated, then maybe Bitcoin can get you done. It's actually looking okay here, right? Above its rising 30-day moving average and, that strongly bullish posture. Looking at the sectors now, you can see that the sectors were mostly lower here today. In fact, let me just see here. Yeah, all of them actually were lower today. The only one that was close to break even, or at least close-est to break even, was communications. It was only down 0.1%. And remember, that's because Netflix and AT&T had huge days. And even though they're not as important as Meta and Alphabet, they are still somewhat important compared to like the smaller cable companies and different things like that. So anyway, On a market cap weighted basis, communications looks okay here. It's kind of like a sideways chart, and sideways is good in comparison to a lot of downtrending charts we see elsewhere. But this is mostly a condition of market cap weighted versus equal weighted. For instance, if you were to look at the equal weighted communication sector, it's RSPC, and look at how much worse the equal weighted, EW, equal weighted, looks compared to the market cap weighted. This looks like most of these other charts, in other words, in a significant downtrend. So when you look at something like not EWC, XLC, sorry about that. It's this is the market cap weighted one, and yes, it looks good, but this is mostly the effect of Alphabet and Meta, right, hanging in there better than a lot of other stocks. So I wouldn't let that necessarily influence you all that much. The average communications company is doing poorly right now, even if the chart doesn't look like it is. Energy stock's a little bit of a different deal. Energy's hanging in there much better, in my opinion, across the board, small to large type of a thing. You can see it's the only chart on the board that is green at the moment from a market cap weighted perspective, and it's also above its rising 30-day moving average at the moment. So this is, one of the key areas where you're looking for, trend trades that are still, look somewhat strong, right, that are above their moving averages and things like that. Energy, by the way, was only down 0.17% today. Probably helps that oil prices were up 2%. So that helps those energy producers usually when you see that type of thing. Staples, surprisingly, has a weekly bullish posture. Not strongly bullish like energy, but weekly bullish. However, again, I'm going to be in one of those kind of mindsets where you got to prove it to me, right? And believe me, if there's anybody on this planet that wants the staple to do well, it's me. I have a lot of staples as a dividend investor. So it's not what I want, it's what I'm seeing here from the short term. And what I'm seeing in the short term is a house of pain. Yes, it's off the lows a little bit, but still well below its falling 30-day moving average. So until it starts trading above that, I'm going to have a lot of question marks as to whether I think that any sort of advancement would have sustainability out of that group. But we'll see. It's possible. It's just that you got to prove it to me first. Most of the other charts look like garbage, quite frankly. You've got so many charts that look like they're just falling off of a cliff. Heck, some of them even have oversold cluster signals. That's how bad it is, right? When you get oversold cluster signals, it's basically saying you have some of the worst selling conditions that you've witnessed recently. Over here, discretionary on a market cap weighted basis has an oversold cluster signal. Discretionary is at multi-month lows. So probably makes sense what we saw in the sector selector, how it was second worst all of a sudden. Well, you look at that chart, even though they're looking at two different things, equal weighted versus market cap weighted, it probably doesn't matter in the case of discretionary. Both of them are doing very poorly at the moment. You can also see that materials ended the day with an oversold cluster signal as well. So not a great look there either. So both of those could be some key areas where we find individual stocks that also have their oversold cluster signals in tonight's video, or tonight's email, I should say. In terms of who the worst performing sector was today, it was discretionary, down 2.56%, but that was mostly your Tesla effect right there. That's basically the result of one company. Real estate was down 2.46%, which was not quite down as much as discretionary, but here it was a group effort. It wasn't just one random big company that caused this. This was like all real estate companies getting hammered today because of surging interest rates. All right, we're now at our hour mark, so hey, I made it. I wasn't sure when I started the video how long I would last here tonight, but we're going strong. So let's finish up on a high note here as well and do a trade application example. Many of you know that when the market is down 1%, those are days when I like to sell puts on what I perceive to be high quality dividend stocks. Usually, every so often I might do something on a different type of a stock. But generally speaking, my MO is that when it's a Tuesday or a Thursday and the market's down over 1%, you can expect me to bring a sold put idea to the attention during this free YouTube video. And while the stock market didn't close down 1% today. You can see SPY was down 0.88%. As I mentioned before, it actually was down 1% at the lows of the day and then bounced from there. And since I didn't do the video last night and we were down 1%, you can, if you need to, justify it in a different way. You could say it's just a makeup trade from yesterday. There you go, right? Either way, we've had tremendous selling lately, and I like to sell puts on days when we've had a lot of tremendous selling because it means volatility is rising, right? If you look at something like VIX, the VIX is now up 20 to 21. As you can see, this is the highest level the VIX has been in months. It's not that 21 in absolute terms is a monstrous number. Remember, if you right-click on the chart and go to maximize sell, you can kind of see the different indicators and different things like that. And then we can also, take a look at a different time period. And if we go back on a 10-year time period here, you can see that during COVID wipeout, when the market fell like 35% in a month, the VIX absolutely erupted. Way the heck up here. It was up at like 80, 90, that type of thing. So where we're at right now at 21, in context of that, is very low. But in context of where we've been just in the last 3 months, we're actually at the highest level in 3 months. So, when the VIX is a bit higher, that's when options premiums are juicier because you're taking more risk and you're going to have to get paid to take that risk. So, you want to be careful with that approach because if you're selling puts on junky companies, you might be left holding the bag and realizing after the fact that it wasn't worth taking that type of a trade where your upside is limited. So you have to be careful with approaching this strategy, and these are the types of things I try to teach to my students in my premium class on Monday afternoons. Anyway, I'm going to bring up our chart 2A here, which is our dividend stair-step chart that I had mentioned before. So this is what I was referencing in those statistics where I was saying that 52% of the stocks under my coverage are trading in the blue zone right now. So like Pepsi, as we're looking at right here, is not quite in the blue zone, but as I mentioned earlier in the presentation, last week for one day it actually was. So this one would not be. This would be part of the 48% that are not in the blue zone. But if you just threw a dart, most companies now are in the blue zone. That's how aggressive the selling has been here more recently. Speaking of companies that are in the blue zone, and one that has been in there for a long time, is Rowe Price. And that is the trade idea that I'm doing tonight. And this is actually a repeat trade idea that you guys have probably seen me do a number of times over the last few years. And fortunately, we've gotten out of them pretty nicely in this market outlook presentation. In one of my other classes, we got our wings clipped. So that can happen as well. You got to be careful, as I mentioned. But fortunately, when I've done the sold put trades for the market outlook video specifically on Rowe Price, they've always worked out to our advantage. So I figured, you know what, let's go back to the hot hand, so to speak, if I've got a reason to do it. And so today, Rowe Price actually hit a 52-week low. It's not a multi-year low. Remember, this is a 10-year chart here, but this is a 52-week low that we hit today. And you'll notice that Rowe Price for the second straight week has an oversold cluster signal. That's those little green dots that show up under the last 2 weeks bars. And that basically means selling has been extreme. And the way I think about that is there's a decent chance of some sort of a reversion to the mean or perhaps just going sideways. But what you're really trying to place the bet on when you're selling a put is that it does not continue to go lower at the same pace that it has in the recent past. That's the bet you're making. And it's a dangerous bet. So I always like to remind folks when I'm describing these trade setups, just because I'm doing the trade as an example in the video does not mean you should. You each, when you're listening to these presentations, needs to decide for yourself, do you want to own Rowe Price for the future? If you do, then it could very well be a trade that's worth considering. If you have no desire to own Rowe Price as an investment, as a dividend growth stock in the future, then you should probably pass on this trade idea because you're just not going to be making enough on it to make it worth the risk that you're also taking. But it does have higher probabilities of success because we sell out of the money strikes. And in this particular case, we sold the $85 strike in the month of December. And so the stock would have to fall $12 more per share. and we got filled at, I think it was $1.15. So remember, we're trying to usually get around 1% return on risk. Today we got a little bit more than that, partially due to the VIX being higher and partially due to us going out a little bit further in time than we traditionally would. We're kind of in this limbo period here where, the Novembers are a little bit early, December's a little bit later on, so you do have to kind of account for that to a degree as well. But anyway, T. Rowe Price does have an earnings announcement coming up on the 27th. So again, when there's going to be a big move, it traditionally is around earnings. And if you don't truly want to own this company, it's not worth taking in the $115 that we did today to place this trade, because basically when you're selling a put, you're putting yourself on the hook for buying 100 shares of that stock at the strike price you selected, in our case, 85. So if it does get down there, of course, the upshot is that our cost basis would be quite attractive, at least compared to where it has been in the last few years. You can see that with today's sell-off, T. Rowe Price now has a 5% dividend yield. It used to be that when you got a 3% dividend yield, you thought it was doing okay. But now it's a 5% dividend yield, extreme. Another chart that you can look at to kind of put that into perspective a little bit more is this chart 2C. I don't bring this one up a whole lot, but if you're a premium member of ours, remember you have access to all of these charts. And with T. Rowe Price, you kind of have to ignore this weird kind of move right here that I'm circling, because that was a special dividend. T. Rowe Price, like a lot of financial companies, occasionally has a special dividend, and Thinkorswim has a hard time kind of digesting that the right way. You can't turn off the special dividend when you're using it for think scripting. So anyway, we just have to put up with that, and I have to explain it when it happens. But that was not the real dividend rate at that time. It was a one-time special end-of-the-year dividend. So if you eliminate that from your view and then look at where we're at right now with this purple line above 5% here, you can see it is by far and away the only time it's even been close to 5% in the last 10 years. And it doesn't stop there. If you went on a 20-year chart, you basically now have eclipsed where this thing was trading back here in February of 2009. Yes, you heard that correctly. Even during the worst crisis of most of our generations, the great financial crisis of 08-09, T. Rowe Price did not have as high of a dividend yield back then as it does right now. That's incredible. And we're talking about right here at $97. And remember what I had just mentioned a moment ago, the trade that I did is not to buy it right here at $97. The trade that I did is putting us on the hook to buy it at $85. And naturally, if the stock were to go down even further, our dividend yield would go up even further. So if you wanted to kind of do that math, let me get my calculator out here. And we take $85, which is our strike price. We then subtract out the $1.15 that we collected when we sold that here today. That means that our cost basis would be $83.85 on 100 shares. And so we'll take the current rate, which they've now paid 3 dividends in a row at $1.22, which means they'll probably pay one more at $1.22, and then they'll probably have a very small increase again early next year. But we'll just eyeball it conservatively and use the information we know right now. $1.22, annualize that to get a true yield, so take it times 4 quarters, means that it's paying out $4.88 at the current rate. You divide that by our cost basis that we just calculated of $83.85 per share, and you can see that the dividend yield that we would have if we were forced to take ownership of it at $85 would be 5.82%, right? If you round up, 5.82% dividend yield. And I just got done showing you a moment ago that in the last 20 years, we're already today at the highest dividend yield. In fact, this may be all-time highs. I'm not sure. This one was not around in the late 1970s as a publicly traded company when a lot of other companies had really high yields. So this could very well be like the highest yield in the history of T. Rowe Price. Now, what I haven't mentioned, but of course I've mentioned in past presentations and on Twitter and in my other dividend classes and what have you, is that T. Rowe Price is also quite a unique stock. Of the 65 dividend aristocrats out there, it is the only one that is debt-free from a long-term perspective. That is really hard to do when you are a dividend aristocrat, because most of those aristocrats are old school, mature companies like Coca-Cola and Procter & Gamble and those types of companies that need to borrow money in order to advance their empire. T. Rowe Price has just chose not to go that direction. They are basically running on their own fumes. They're not borrowing money to run their business. They don't owe money to anybody in that regard. And when you're in that type of a solid position, it means that your dividend is much more likely to stay safe. It's not a guarantee, because there are no guarantees in this business. But if you're talking about one company that's heavily leveraged and owes money to all kinds of other creditors, banks and debt holders, bond holders, what have you, and then you've got another company that doesn't owe any money to anybody, which of the two are you going to choose that would more likely than not protect their dividend? To me, the answer is obvious. It's the one that's debt-free. So T. Rowe Price has a difficult business model right now because they earn fees on assets. And with bond prices going down dramatically and now stock prices too, assets are going down, and therefore the fees they're earning is going down. So it's not all roses out there. There's certainly reasons why their share price is down. But as a dividend growth investor, what I care about is, do I trust that the dividend is safe? Even if the earnings from time to time will go up and down and be cyclical, right? That will happen. And it's not just going to happen now. It's going to happen in the future with these types of asset management companies as well. It's always happened, and it will continue to happen. So that out of the gate. What you don't know is which one of them are going to cut their dividends, which one of them are going to keep their dividends safe. And from my perspective, despite T. Rowe Price being in a more difficult position right now from a business model perspective, because they are not leveraged, they are like the last of the aristocrats that I would assume that would cut their dividend, even though they have a very high yield of 5% right now. So if things change in the future, of course, my mind can change. But right now, based upon what I know, I would say that their dividend is pretty safe, despite having an eye-popping yield. And if we were forced to buy it, it would be even more eye-popping at a 5.82% dividend yield. So again, be careful with this type of a trade. Only do this type of a trade if you truly want to own the merchandise in question for the future. But if you are somebody that is interested in buying more financial stocks for your long-term portfolio, then maybe this is a trade that could be useful to you. Okay, so there's the trade idea for the day. Hope you enjoyed the presentation. Went a little bit longer than I expected tonight, but there was a lot more to talk about today as well, with all the crazy things that were happening within the market. So thanks for bearing with me there. Again, remember, tomorrow David is not here. He's out of town. He won't be here Monday either. So the next time you'll hear from either of us will be Tuesday when I do this video. If you want me to do another full feature video like this one, I ask one request out of you. Click like for me there on Twitter. It'll be pinned to the top of my timeline. You can also find it directly underneath the video that you're watching. If you're watching it on our Market Scholars website, you can find it in the description area of the YouTube video if you're watching it over there. And you can also find the link in question within the Twitter icon on our emails that we send you. So 4 different ways will get you done, either way you choose there. If you don't want me to do a full-length video, then don't do anything. Just, click skip to the next video, and your vote will be collected accordingly. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.